Welcome to another video update from Sebold Capital Management. My name is Sean Sebold. I'm president and founder of Sebold Capital. Today on our video update, we're going to talk a little bit about insurance. I know, the most exciting thing in the world, but let me tell you, it's important. So here's what's on our agenda. We're going to talk a little bit about evaluating insurance, but before we get to that, we first have to start with a fundamental question. What is insurance? Insurance is a transfer of risk. That's what it is. So what you're doing when you're buying insurance is you're paying somebody else to take a risk that you don't want or cannot afford to take yourself. So when you're buying car insurance, you don't want to take on the risk of fixing someone else's car if you crash into it, paying a liability settlement, all that kind of stuff. So you want to transfer that risk to somebody else. So you're going to pay them to take on that risk for you. Okay. What are you trying to do? You're trying to keep the life that you currently have and the assets that you currently have and you have grown accustomed to. So what's really fascinating about that is if you didn't mind having your assets or your things in your life change, then you wouldn't need insurance. If you burned your house down and you couldn't afford another one and you thought that was okay, who needs insurance? But of course, what's really fascinating is the United States is one of the wealthiest wealthiest countries on the planet. However, it also has the most insurance because people want to protect their assets and their lifestyles. So coverage policies can be almost anything. I've mentioned just a few of them: house, life, cars, art, even alien abduction insurance. Not a real big market for that, but it can be had. K&R insurance, very well known, which is kidnap and ransom insurance if you're doing work in third world countries or countries that you don't feel safe in. So lots of things. Anytime there is a risk, you can generally insure it. Okay. So what's the value you should pay for insurance? So how do you know if you're getting a good deal and a bad deal? Okay. So Daniel Kahneman, in his book, Thinking Fast and Slow, talks a little bit about an example of this. So let's take a look at this. You have a 5% chance of losing 5 million or a 95% chance of losing nothing. Okay. So the question is, which would you choose? Would you choose the 5% chance to lose $5 million and a 95% chance to lose nothing, or pay $300,000? This is the insurance question. So 300,000 in this example would be the premium. So the question is it the right number? So which option do you think you would prefer to do? Guarantee the 300,000 payment or take a risk on losing 5 million? What if this happened 20 times? Would that change your thinking? How about 50 times? How about 100 times? More times this happens, the more times you look at, let's pay the premium. More importantly, are you paying too much? So if you do the math, 5% of 5 million, that's going to be 250,000. So 300 is in fact a little bit overpriced. But again, is it worth it? Depends on how much risk that you want to take and what risk do you want to hold to lose that 5 million. This is the concept of insurance. Okay, so let's go back in time. I'm living the same way, am I living the same way I was back then? So this is, to frame this particular example, is, do you need the insurance that you currently have? Okay. So why did you buy insurance? And again, this could be car insurance. This could be life insurance. This could be housing insurance. Why did you buy it? Well, when was the last time I could have needed this? So when you buy life insurance, you're generally buying insurance to take care of the family that you're growing. If all your kids are gone, will you need that life insurance anymore? You might be using life insurance to pay for a estate plan. Do you really need that life insurance anymore? So you always want to look back and say, is the circumstances the same today as it was when I purchased it? Okay. Now let's rate the carrier rating. Let's see what happens here. Is your insurance performing as expected? You do want to evaluate it pretty frequently, because if you don't, it can be costly. Inefficient insurance growth may also result in a lack of coverage. So what does that mean? In today's environment, we've seen property values grow up substantially. Do we have a replacement value that makes sense, that still covers the value of that property. So inflation has a very, very large impact on insurance. You have to keep up on that. Is there enough liquidity available for the large houses and things like that? So those are certainly important. Inflation is a big component on insurance and whether you're covered. You might be covered at a 5-year ago house rate, and you might not be covered for enough today. Okay, many prompts to lower insurance coverage. Okay, I talked about one. The children move out. Okay, they don't need to rely on you anymore. You sell a high risk asset. If you have lots of motor or water vehicles in the water and you use those motorboats, things like that, that's a high risk asset. So insurance and liability premiums can go up as a result of that. Perhaps you have some coverage overlap. A lot of insurance companies sell identity and theft insurance, and that also may be covered under another policy that you may have. So looking at that is pretty important. Health improvements also can impact your overall insurance, especially from a long-term care perspective. So if you got your long-term care and your health improved, you might be able to go through underwriting and lower those. So what do? You do stress tests. One of the best ways to check that. Consider major events on different time scales, whether it's a short-term time scale, long-term time scale. This has to do with, how long or what should you keep permanent insurance, or when perhaps term life insurance starts to go, you might go away and you might want to convert it to term. Well, gee, that depends on quite a lot of things that have to do with time and time scales. Account for different interest rate spreads. That's pretty important when you're looking at the cost of insurance and whether you have whole life policies or not whole life policies. So you certainly want to talk to someone who knows this stuff inside and out, consult with an advisor, and look at your circumstances. Have they changed? So key things to take away. The primary goal of insurance is to cover need. It's to transfer a risk that you do not want to take. Insurance is needed tomorrow. It's never needed today. So that's what you're doing, is you're protecting your assets and your life for tomorrow. A quick look could save you a great deal of cash. You just have to run the numbers and say, does this make sense to me? Really important to look at this stuff. So thanks for watching. Really appreciate you being here, and we'll talk to you in the next one.